Stock picking in tough times. We are in an era of relative economic and market uncertainty for reasons both external and internal, and we've touched many of them, at least the external ones today. There are several somewhat broader questions, including whether and when domestic demand and Indian company performance will start looking up. Now, all of these issues are somewhat beyond our control, and particularly what Trump will or will not do, and whether he will do everything or anything that he threatened to do. So, how should all of that affect our outlook of stocks and their performance in 2025? I reached out to Aashish Somaiyaa, CEO of the Mumbai-based WhiteOak Capital Mutual Fund, which manages about $2 billion in assets across several schemes. And I began by asking him what were the factors playing in the market or on the market as we entered the third week of 2025, and more importantly, his firm's approach to stock picking.
So, recently I was on a television show and, quite inadvertently, I was asked that what do you expect when Mr. Trump comes to power? So I ended up asking the person, are you the same guy you were 4 years back? There's a lot of extrapolation being made from his past statements. I don't think anybody is going to conduct themselves the same way that they were 4 years back. And I think all these talk about tariff, probably, tariff is just a means to an end. I don't think there'll be actually huge tariffs. I mean, if you don't do 1, 2, 3, 4 things, then I'm kind of threatening you with tariffs. Whereas if you see the market is already assuming that there will be tariffs. To overcome tariffs, there will be devaluation. Because of China's devaluation, competitive devaluation in other parts of the world. So I think market has kind of run ahead of itself, trying to factor many, many things. But I don't think it's exactly how it may actually play out, So we should be open-minded. We have to see exactly how he conducts himself. Plus, of course, not the same person, not the same administration. I think the entire lay of the land has changed.
Right. So let's come to the Indian market. The 3 or 4 factors that we know now. One is, of course, earnings have slowed down. The second is valuations by some, if not many, institutional investors are still being seen as on the higher side. And the overall economy projections for growth are also now slightly lower. And there are some challenges on the demand side. So this is all that we know, for which there is some data to support it. So how are you seeing the market at this point?
See, my sense is that it will take us the first half of 2025. Although your first question about Mr. Trump, and like I said, we just don't know. We have to see how it plays out. Apart from that, clearly, the kind of slump we had in the first half of FY 2025, largely because of government spending, maybe unintended consolidation, many of those things playing out, we have to get out of the woods on that. We have to see US policy clearly. So my sense is that first half of 2025 calendar year, we are going to be meandering, maybe 10% up, 10% down. We need more clarity on external macro. We need more clarity in terms of how our economy comes out of the some kind of temporary depression that we are in. Even corporate earnings, we have to see how things shape up in the next 3 to 6 months. So I think that even 2024, how good it was, I don't think 2025 is going to be that good. Definitely not the first half. Maybe I'm more hopeful about the second half once we have clarity on multiple uncertainties that we are passing through right now.
And how are you seeing companies who are delivering, let's say, better performances but not blowout performances? And do you think that is good for the stock prices, or is it just keeping them where they are?
What is happening is that also on valuations and obviously then juxtaposing with corporate performance, at different points in time, there are different reasons why the market does what it does. And, there is different points or factors driving the market. So now let us say in the last 3 to 6 months, we've seen market correcting because of Trump trade. And then, of course, our economic performance or, the government consolidation, etc. But I think it's a healthy consolidation or a welcome development. For whatever the reasons may be, I think I'm very happy that the market is not doing too much. Let's say if you were to say that 1200 Nifty EPS 1 year forward, then I think things are, at least on the large cap front, things are kind of coming to a reasonable level. Otherwise, you would have feared a lot more downside. Instead of talking plus minus 10%, we would be talking a lot bigger numbers on volatility if we had not seen already what has happened in the last 3 months. Instead of 2024, just one way up, what has happened in the last few months has given us a lot more comfort. Even if you see, for example, small cap, mid cap, a lot of stocks, order books being built into the prices, a lot of bullishness being built into the prices. So from every perspective, this consolidation or even a 10 to 15% correction is more than welcome. Because from here on, then we can expect that things will move in line with earnings and it's stock picking which will work. See, the other challenge with 2024 was that it was not so much stock picking. Certain macro trends or certain factors were driving entire sector after sector. And there were some others which were just not in the attention. Say, for example, if you were to look at some of the large private banks, if you look at some of the large NBFCs, even if you look at smaller financial services or NBFCs or lenders, what was happening was that what's not working is not working, and what is working, everything seems to be flying. So the market was not discerning or discriminating in 2024. Everything was in tandem. Why I said last 3 to 6 months we are happy, because it's kind of mixed up performances. I think stock picking starts working. With this correction, everybody starts looking more on the earnings, and things become more earnings focused, which means things become more stock picking focused. And that is something which we are always happier with, rather than seeing market being driven in tandem by certain factors or macro tailwinds.
Right, including narratives. So let me come to stock picking in a moment. But before that, how are things looking on the supply side in terms of investors coming into your fund? And are there any trends within that you've seen?
What we've seen is that investor interest is still holding up very strong. You know that, last 3 to 4 years, number of new investors, not only opening broking accounts, but even mutual fund accounts, SIPs, the whole trend has been very encouraging, and we've seen growth by the millions. What I've seen is that a lot of our fraternity, or a lot of my peers, a lot of commentators, they seem to be attributing it largely to cyclical factors. Where the market is booming, it is attracting a lot of people. My sense is it's not just cyclical. I think a lot of it is structural also, because today you're 21, 22, 23, 24. You take any age, there are some 2 to 2.5 crore, 2.25 crore people out here. And in last 20, 25 years, whether it is digitization, whether it is absolute level of interest rates, whether it is our regulatory architecture, everything has changed. So my sense is that a lot of youngsters joining capital markets directly or through mutual funds, I think that's a trend here to stay. I don't think that is going anywhere. So very, very positive on the supply side. My sense is that we are going to see this kind of momentum. See, market going up and down, it will always motivate some people more, and market going down might discourage some people. Those delta changes will be there. But I think overall, my sense is that this influx of people into capital markets is a structural thing. It's a trend which is here to stay. And I don't see any serious challenge as far as investor interest is concerned. If interest rates were to rise dramatically, or if there were to be a scam or something really backbreaking which destroys motivation of people, that would be an outlier thing. But otherwise, things being as they are, I think that investor interest is here to stay. We have not seen anything to tell us that people are getting demotivated from investing.
And what's your, let's say, proportion of bulk flows versus SIP flows? I mean, I know you're a more institutional focused, or large investor focused, but having said that.
So, WhiteOak, just very quickly to give you lay of the land, we are about 7 billion as an FII, managing money for foreigners, and about 3 billion is domestic. Now, in the last 2.5 years, our mutual fund, which is retail, is well over 2 billion in size. So, if I see the mutual fund, for instance, we are like more than 610,000 unique clients, very retail, all across the country. We have our ears and eyes plugged to the retail landscape. I've been tracking this 25 years now, always worked on retail distribution, meeting retail clients. And I think that the interest is pretty much there. The mutual fund industry, what MF Sahi hai, which has been done for the last nearly a decade now, I think that has really helped. And of course, digitization has killed information arbitrage, has made discovery very, very seamless. So I think these trends are definitely helping us.
Right. Okay. So let me come back to stock picking. So, what would you say are your principles of stock picking? The principles, not the stocks themselves.
So, two things. I think WhiteOak focuses on both. I think stock picking, and I'll answer that. But I'll also bring to your notice that, in our industry, stock picking is the hero. Typically, that is where all the folklore and all the credibility and credentials are shared. What WhiteOak also focuses a lot on is portfolio construction. So, as far as stock picking is concerned, look, we believe that we have to buy great businesses at attractive valuation, and there's no third way to do it. The point is, what does one perceive as great business, and what does one mean by attractive valuation? So for us, great businesses are, 2 or 3 things. One is that they need to be in sectors which have long-term growth potential. Second thing about great businesses, great management and execution. So this is great business. Now the point is that valuation. So typically what we do is we have our own in-house proprietary valuation model. We call it OpCo-FinCo framework. Basically what we do is, it's ad nauseum repeated that value of a business is present value of its future cash flows. It's not future EPS or PAT or anything. So one is we value everything at cash flow, free cash flow basis. And second is only the economic profit or the excess free cash flow, which is that we do present value only for free cash flow over and above cost of capital. So every business that we evaluate, we segregate it into an operating company and a financing company. The financing company is the one which holds the land, factory, the capital, financing. That is all with the financing arm of the company. And we simulate as if the financing arm of the company is providing all of this for a cost to the operating arm of the company. Now, the operating arm of the company has to do the sales, marketing, product, etc. And they have to generate a revenue. The first thing we do from the revenue of the operating company is to subtract the charges for using the factory and the capital and stuff. So what we value is the operating company, and we value the operating company only for the cash flow that it produces in excess of the opportunity costs. Generally speaking, the market uses many heuristics like EPS multiplied by PE. Typically, people use PE multiples. Now, what happens is that when you use PE multiples and when you apply a multiple to a particular profit, generally what happens is that these profits are not free cash flow terms. Are those profits even in excess of the cost of capital, efficiencies of companies? So, generally, what we do is that we do everything on free cash flow basis and free cash flow only over and above cost of capital. And the second thing which I mentioned, so this is about what type of stocks and what type of valuation model we are following. Plus, of course, this valuation model is not applied ad nauseum to the entire industry. It is for intra-sector evaluation. The other important thing is, like I mentioned, portfolio construction. So you must have noticed that every second year or third year, the best performing fund house, and fund manager keeps changing. Now, why that happens is because in everybody's investing style or stock picking, there are certain biases or there are certain favorites. People want to pick a certain type of stock or they have a preferred recipe. But as I always say, the benchmark, like you say in Hindi, ban gadi bhi din mein do baar sahi waqt dikhati hai. So the benchmark is such that it has anything and everything. So if I insist on picking stocks of a particular type, what will happen is that under certain conditions, I will massively outperform the benchmark. When the conditions change, I will underperform the benchmark. So, look at it this way. 5 years back, it was growth. When 2019-20 came, it was all about quality and defensives. When 22-23, it was all about value. When factors and macros change, best performing funds and fund managers also keep on changing. So while WhiteOak does bottom-up stock picking, at the same time, we are very, very aware that what are we competing against? We are competing against the benchmark. And how do we construct the portfolio in a way that it keeps us instead to outperform the benchmark on a consistent basis? So a lot of emphasis on portfolio construction. We call it balanced portfolio construction, which is basically factor balanced and sector balanced. And you take only the stock specific risk.
Right. Last question. We've got the budget coming up. Everyone has some kind of demand, request, wish list. Do you have any as an industry or otherwise?
I would say that if we don't make any changes, that's a good start. Because we have to get used to whatever changes we got last year and maybe even before that. So if there is no change at all, I'm happy because it takes time for people to get used to and start factoring things in. And we just had the last budget maybe 8-9 months back. So I hope that there are no changes at all. And if at all something is going to be done or something is going to be heard, then I think we should reduce STTs and those kind of transactional things. Look, we reinstated capital gains. Now we should make markets efficient. And, we should not have all this STT and this kind of friction when it comes to trading securities. And plus, STT is something which is way above target. It's only going to rise and it's going to become bigger and bigger friction. So I think that is something that should be genuinely reviewed. Otherwise, I have nothing to add, on long-term gain, short-term gain, etc. I just feel that once we harmonize, we decide something and stick to it.
And more premium on the consistency of policy rather than the evolution of it.
Absolutely.
Ashish, thank you so much for joining me.
Thank you. It's an honor. Thank you.